Hello guys, this is Hustle Hub with another pill for you about ETFs. But before we get started, remember to subscribe and smash the like button. So let's get started. An ETF is a great financial instrument for investors. It stands for Exchange Traded Fund. An exchange traded fund is a basket of securities that trade on an exchange just like a stock. It is a fund because it collects money from people and the fund managers manage it. The advantage of having an ETF is that it is already diversified rather than a stock, which can be very volatile. There are an uncountable number of different ETFs. They can replicate an index like the ETFs that hold all the stocks that are part of the Standard & Poor's 500. Otherwise, you can find ETFs invested in a specific sector, like gold miners or technology. For example, we've seen VanEck making an ETF focused on gaming and esports. You can also find them for the distribution you want to have. For example, there are ETFs that select only stocks with high dividends. They charge a fee which can be very low, especially for the most passive kind of investments, like the ETFs that replicate an index. You can have higher fees in more structured ETFs. You can also have ETFs that invest in government bonds or corporate bonds. Furthermore, some ETFs pay dividends to the investors. Others take the money paid out by the stocks held in the portfolio and reinvest directly in the fund itself. If the ETF pays out dividends, the ETF will have a dividend yield.
As in everything, there are pros and cons. Indeed, ETFs surely offer diversification, and it has low expense ratios. Moreover, they're tax efficient and they offer exposure to equities, currencies, and other assets at different levels like sectors or countries. ETFs can be a smart investment choice for long-term investors because of their low cost and the ability to buy and sell them out on the stock market, making them the most popular type of exchange-traded product. So, we can say that ETFs are a form of compounded interest, which means that the interest that you earn on a balance of a saving or of an investing account is reinvested and you earn more interest. In this way, compound interest accelerates the growth of your saving and investment over time. On the other side, we have to consider that the commissions can erode returns depending on your broker, and some ETFs have similar volume which creates higher bid-ask spreads. Moreover, some of them are also taxed higher, for example the ones which hold precious metals like gold. To get to the point, ETFs are a really good investment for a long-term run, which means that you are willing to wait around 5 to 10 years or even more depending on your purposes, but the returns are going to be amazing because of compound interest. For example, let's say that you invest today $1,000 in ETF. With the use of compound interest, after 10 years, that $1,000 are going to skyrocket in value. You have to think that the market value normally grows by 1.2% every single year. So, with the use of compound interest, after 10 to 20 years, that $1,000 that you invest can become easily $1 million or even more depending on your activities and your investment and how they goes. Having said so, you can easily realize the potential that comes with the combination of ETFs and compound interest, which they really make reality. The so famous phrase, don't work for money, make the money work for you. I'll see you in the next video. Here's Hustle Hub.